Parag Thakkar, Senior Fund Manager at Fort Capital, joining us this morning. Parag, great having you here. Let me start off with one set of companies which will surely be in focus, and that will be the PSU banks. You had a rating upgrade by Moody's on PNB, Canara Bank, and I believe Bank of Baroda. At least these three banks featured in that list. What does this do, Parag, in terms of their cost of funds? Do you believe that it is a material benefit to them, and how do you view this PSU banking pack? I know you like SBI, but what about some of the other smaller banks?
No, we like the entire pack. We've invested in PNB, Canada. SBI is the largest weight in the portfolio, 8%. And we have seen a fantastic rally. We have booked profits in smaller names, but we still remain very, very constructive on SBI. And see, this is already the cost of funds for PSU banks is already low. They are not like NBFCs where, like for example, PNB Housing also saw a rating upgrade. So PNB Housing definitely will benefit from lower cost of funds. But in case of PSU banks, I think the cost of funds are already low. So I don't see any significant benefit, but I think that the PSU bank as a pack will continue to do well.
Okay, that's the entire PSU banking pack. Kunal, on the charts, what's looking like the strongest? X of SBI?
Yeah, I think PNB, Canara Bank apparently is one of the strongest name. The stock has been doing very well, closer to 149, 150 mark where it closed yesterday. PNB at 123, 124. Also one of the other ones. Bank of Baroda has been a bit of a struggle. I think the stock has not been able to find its clean momentum breakout in technical terms. So maybe that stock could slightly be termed as a underperformer with respect to the other peers. But I think Canara Bank has been one of the best performers from the entire pack, X of SBI in the PSU banking names.
Parag, if I were to get your sense on the unwind which might happen as a result of the India-US trade deal, if at all that were to get penciled out, because that will be the next big event which the market will watch out for. If that were to come through, do you see material upsides in some of the sectors like textiles and others, pharma, textiles? Are those pockets looking interesting if that were to play out?
Definitely. So we have, for example, bought Indocount and Welspun doing both small weights, although in our portfolio play this tariff reduction theme. And also, just to tell you, a small company called, and with a full disclaimer that it's a small cap, we have a significant weight in our portfolio. So your viewers should please consult financial consultants, advisors before taking any call. There's a small cap name called LG Equipment, which we have in our portfolio. It's a great company, 65-year-old company, most hardworking promoter, debt-free company, 20% ROC, bottom of the capex cycle. And I would say that aftermarket is 28% of the revenues, and they are trying to grow their installed base. And in spite of 50% tariff in US, they grew their North America business this quarter also. And they said on the call that they have taken all the steps to mitigate this tariff pressure. So once the tariff covering comes down below 20%, which is wishful thinking, but I would say that it can happen, then this company can do extremely well because 25% of their business is in US. And it is right now having 50% tariff. Still, they have grown that business in this quarter. And remember, it's a very high longevity business because 28% of the sales is aftermarket. So it's a sticky business with high margin, very good ROC, and there is no capex cycle right now in India also. For example, now that GST cuts have been happened, repo rates have been cut, government and RBI both are pushing for strong consumption-driven growth. Definitely that will trigger capex cycle also. And compressors are used in all industries, auto components, pharma, FMCG, anything you see, even data centers have to use it for cooling. So I would say that we have also, I would say we would love to play this theme. It's a very good theme that which company benefits out of tariff reduction. And so we are playing it through these three names mainly.
Parag, just one follow-up, because you've studied this company ever so well. The margins I see have gone up from single digit at the end of the last decade to a healthy 14-15%. Any color on why that has happened with regard to LG? By the way, viewers, it's a 16,000 crore market cap company trading at 40 times. So, Parag, if you can give us that perspective.
Yeah. So basically, see, aftermarket is very important for them because aftermarket comes with a higher margin and stickiness. So I would say that aftermarket has helped them. Plus, they are very, very innovative company. They are sixth largest company of compressor in the world and second in India, and a very innovative company. So they continuously innovate. They continuously reduce their costs. For example, as I told you, right, after 50% tariff, they were able to grow their North America business, and they were able to mitigate the cost also well, as reflected in the last quarter's result. I would say that there are some companies which are in a temporary problem at the bottom of the cycle. One of them is this. And promoter quality, the balance sheet quality, no debt, high ROC. So it fits all the criteria.
Parag, morning. This is Sajid here. I just want to get your views on Infosys. The buyback starts tomorrow. How should an investor position itself for the buyback? 1,800 rupees. The current stock is currently trading at around 1485.
See, I'll tell you. So we are underweight in IT as of now, but we have Infosys as a large weight in our portfolio along with Tech Mahindra. These are the two names, and we have totally around 7% weight, which is underweight compared to the benchmark. But what I feel is that, see, right now we are in a era where the old traditional, the way of rewarding shareholders doesn't work right now, as of now, primarily due to two things. One is people just want to fund growth. Okay, so people want to give 10,000 crore to a company who is just building a war chest to fight against a competitor, in spite of having 8,000 crore cash. But just to burn the cash, they want more cash. While on the other hand, we have a company like Infosys, which is giving you 4.5% to 5% dividend yield. They are doing a buyback of 18,000 crore. Of course, for some investors, it will not be great due to the tax implications. But I would say that at least the company is reducing the share count, right? Which in long way, and this kind of muted scenario for IT discretionary spending is not going to remain forever. It might continue for another 6 months, 9 months. So when you see the increase in growth and discretionary spending, that time the share count will be lesser by 3%. So they are in a way increasing the intrinsic value of the company in future. So I would really welcome the step, although due to the tax implications, the buybacks have become very less lucrative for investors. But from company's perspective, it's a great step. And people just don't realize that this is a company which is giving you 18,000 crore. And, people want to fund loss-making companies. So this is a great anomaly, which I would say that will not exist for long, but it might continue for 6 to 9 months.
Okay. All right, we'll pause it at that. What we'll do is we'll carry this conversation forward after this very short break. Stay with us. We'll talk more about IT, by the way. Need to take a technical view from Kunal as well. Stay with us.
In association with
Welcome back. We were talking about Infosys just prior to the break, and just trying to give a perspective to shareholders on what they ought to do. A lot of what you do will largely depend on your taxability, because when you opt for the buyback of Infosys and when you receive 1,800 rupees per share, that will be taxed. That 1,800 rupees will be taxed on your slab rate, and therefore if you're on a lower slab, it's more favorable for you to opt for the buyback. And if you're in the higher slab, it may disincentivize you from opting for the buyback. Also, the cost of acquisition of the shares, and this is probably, Sajid, the reason why promoters are not opting for the buyback, because the cost of acquisition is available as a deduction against your capital gains or losses for this year. So, and if your cost of acquisition is super small, the benefit that you may get may be at 12.5%, because that's the rate of long-term capital gains tax on listed equities, versus the 30 or 40% you may actually pay out for the buyback that you opt for, and therefore you may just be better. Yeah, and you therefore may just be better off selling it on the exchange rather than opting for the buyback, because the tax difference may actually leave you better off selling on the exchange.
If you're a foreign investor, you will better off because you have a double taxation treaty that avoids any
That's
taxation. Or if you're a small investor who don't fall into an income tax bracket, then it's better off to participate.
Correct. But for foreign investors, the taxability is different. We're
Yeah.
just talking about
Yeah.
retail for now. So just want to clarify that. Yeah. So broadly, it'll be tax which will determine the way in which this goes. So therefore, you want to go consult with your advisor and get that sense. Kunal, IT first. Give us a sense. Where do you sit on this one? We spoke about this late yesterday as well at close of trade. Any bets on IT today, given the kind of correction we've seen, 4% lower over maybe the last few days that we've seen, 3 to 4%?
So I wouldn't be as bearish as the street would be for the IT index, because largely I think we are still in that phase of attempt towards the IT index trying to break past the resistances. After a 2,000-point rally in the last 3 weeks, we've seen the last 4-5 days the Nifty IT index shed 900 to 1,000 points from 36,800, 900 mark to now 35,950 thereabouts for the IT index. So broadly, I would believe that it's a retracement of sorts. We are still trading about the 50 DMA. Short-term trends, they generally start to become negative once the asset class or once the index breaks below the 50 DMA. Right now, we are still above those 50 DMA levels for the IT index. So I would wait out for a point where the IT index retraces back towards 50 DMA, try and go for a contra buy and assess whether the bounce back is quite sharp enough. But on the short-term side, I would still believe that the trend is not very negative. I'm not saying extremely positive, but not very negative as the street is signaling for the IT index.
Okay, now
HUL. Now, the stock has been absolutely flat. 4.5 years, it's given zero returns to investors, and still trades at 50 times. Would this at all interest you, or would this be a contra at this point, or would you just avoid it?
No, so we have recently bought 4% weight in the HUL when it started falling after the results. And I'll be very constructive going into fourth quarter, because the management has already indicated, and this is HUL management, right? This is not some hanky-panky management. They have indicated that from November, this GST-led disruption on the ground will stop and things will start turning. As Mahindra and Escorts have also upgraded their tractor volume growth guidance, I feel that rural India should do well. And FMCG pack will come back, but HUL is, as you said, I like the underperformance of the blue chips. And so when such good company, and see, these companies have a huge longevity also. I don't see HUL vanishing from the market after, say, 10 years, 15 years, or 20 years. While some of the companies which are getting huge values right now might not exist. So I would say that HUL is a good contra buy. This ice cream business is a 15 to 20% growth business, and HUL shareholders will get 1 share for 1 share. So this ice cream business is the highest growing piece, which HUL shareholders will get. So this will also create some value. And more importantly, from Q4, I think things should look up, and then HUL should start outperforming from November, as per management guidance only. So I would say that, I have a slightly overweight position, which is 4%, which is very recently bought, and this is a good contra buy for me. In fact, HUL, Infosys, they are good contra buys apart from PSU banks, which are right now in momentum, as I said about SBI or say Reliance or L&Ts of the world. So I would say that I see more value in large caps, and these are my large holdings.
Parag, what could be the intrinsic value of the ice cream business once it's demerged on record date?
I think 60 to 70 rupees per share.
Okay. And do you have a similar view on other FMCG companies as well? Marico has had a good earnings season. Dabur and maybe Godrej Consumer?
So basically, right now we hold HUL. Marico, we saw a good outperformance. So we booked some profits there, but I would say that Marico's commentary was excellent. 7% volume growth in this quarter, in spite of huge spike in copra prices, and now copra prices have corrected 15%. Dabur, definitely things were not so well up till now, but I think this time winter is related to be very intensive, which augurs well for Dabur's portfolio of Chyawanprash and all. So I would say, and which is a very high profit making product also. So I would say that this is an interesting contra bet, FMCG and IT both.
Interesting analogy there, both on Unilever as well as the entire FMCG pack.
Come to you with regard to Tata Motors PV. There's just so much happening in this space, both in the auto space as well as Tata Motors PV in particular. It's been the largest underperformer from 1st of October. I was just pulling that data out within the Nifty 50 pack. Justifiable, just the kind of numbers that it's come out with?
So Tata Motors PV, my view is very simple, that JLR is a very, very complex business always to understand and so to value. Plus, it requires a lot of capex and a lot of R&D expenditure. And I would say that if I see the numbers of other luxury car manufacturers, I am sensing that Tata Motors JLR is losing some ground over there, which makes me feel a little bit uncomfortable even at a lower price. So even before on other channel also, I have said that this is a stock which I would like to right now, although Tata Group is my favorite group and I would love to buy them, but I would say that this is a very complex company to value, and hence I will stay away from it at least for some time till JLR outlook improves.
And this finally, long hibernation that Asian Paint seems to be coming out of?
See, the great companies always find their ways out, right? So Asian Paints is one great example. So the last 1 year was a little bit tough for them, but they have now come back. So I would say that, and now we are nearing a festive. So festive season was already there, and now wedding season. So I think, and now with the peak of the disruption from Birla Opus is behind, I think that paints as a business should do well. We have, of course, Asian Paints at a much lower price and then book profits also. So we are not a buyer at this price, but I would say that the worst in the sector seems to be behind, clearly.
Do you look at some of the Adani companies? We have an brokerage IDBI Capital initiating coverage on Adani Energy with a price target of 11.95, and also we saw in yesterday's trade a lot of block deals happening between funds managed by GQG and taken over by the GQG emerging market fund. So there's a lot of churn of companies happening globally as well with respect to the Adani group.
No, so I think just check on this, that whatever we are seeing GQG has bought, I think it is inter-transfer.
It is an inter-transfer.
Yeah. And plus the other thing is that, one of the things, of course, we have not bought into it yet, but in Adani Enterprise, we saw that there's a right issue coming at 1800, worth 25,000 crores, and where promoter owns 73% stake. So promoter is going to put 18,000 crore at 1800 rupees. Which gives me a good comfort that promoter is committing money of such a large magnitude. Of course, it is at a discount to current market price. So I would be a very close watcher on this, and I would like to buy it when stock price corrects a bit, if it corrects.
Also, if you can comment on some of the companies, I don't know whether you track PVR. Do you look at PVR Inox?
Yeah, so we have a small weight of PVR in our portfolio. What I have been observing is that after COVID, the first time there are many, I would say, customers who are entering into theaters at least to experience I would say the theater experience, I would say, and that is a positive news for PVR. This is also a company where it was disrupted massively after COVID, and everybody just wanted to watch OTTs and nobody wanted to go to theaters. But due to some interesting content coming in last quarter, I think the footfalls have clearly been on the increase. So as the occupancy rate improves, I think company should do well. So we have just got a very small 1.5% weight in this company, and we'll wait and watch and see the numbers. If in fact, last quarter number was fantastic. If they can repeat that and the content keeps on exciting the viewers, I would say that this is also one company which is at the bottom of the cycle, completely ignored, market cap of just 10,000 crores, which is peanuts right now when you are seeing a market cap of 44,000 crores for a loss-making company. And so I would say that it's a forgotten stock, and that is why we have bought a small weight, and we will wait and watch.
Parag, what's your take with regard to some of the QSR names? I read a very interesting note today morning from Citi suggesting that Jubilant is far outpacing its peers, both with regard to average daily spend, which is ADS, as well as with regard to operating efficiency, which is playing out. Do you like any of these names, and are they at an interesting inflection point, one of those ignored sectors?
Yeah, I would like to believe that. We have not yet bought it. We are watching this very closely, like we are watching PBR, the world, and but this is again a good contra bet. It can be a good contra bet. Once this company also used to get very high valuations based on long-term things, which many other companies are getting right now. But this is again a ignored space. I think overall consumption is on the rise because of higher disposable income in the hands of middle class. I would be a close watcher on this space, and I would definitely look to buy some of these names at some point, depending on price. And I agree with you, Jubilant Food numbers were very good, absolutely outperforming the entire QSR others peers. But I would say that even Westlife, we saw some promoter buying. So I would say that it's a good space to watch, good contrast space to watch.
Okay, that's this take coming in on the entire QSR pack right now. But let's get in some mid-cap strategies before we move forward. Kunal, what's on your list?
So an interesting name, Container Corporation, a stock which on the short-term charts seems to be tapping back into a very interesting and important support level at the 500 to 510 range. Yesterday we saw the stock trying to make a comeback, volumes were slightly higher. My sense is that the stock could probably have formed a near-term bottom for itself if it holds on to this 500 odd levels. So look out for a contraband Container Corporation, targets of 540, stop us at 513.
Okay, that's Concor, and that's a buy from Kunal with a stop loss at 513, target 540.